In today's world of market volatility and uncertainty, your retirement plans need to be front and center. With ever-changing tax laws, healthcare worries, and an unpredictable stock market, don't overlook the vulnerability in your retirement planning. Protecting your family and estate will be difficult with shifting policies in Washington. It's more important than ever to keep an eye on retirement.
Hi, and welcome into Eye on Retirement, the weekly show that keeps you in the know about all things retirement. I'm your host, Rick Everett, along with our panel of experts for this edition, senior partner and managing partner, as well as financial advisor Matt Goolsby.
My dad might not take too kindly to that.
I realized that right as it came out. Our lead CPA with Market Tax Services, Joshua Cicora. Bill Vawter, lead Medicare advisor with Market Medicare Advisors, and Gerald Eidelman of Eidelman Law Firm. Matt, in life and planning for retirement, there are lots of ways to get it wrong and a few ways to get it right. And in a scenario that you're about to lay out for us, there were a lot of variables that came into play.
Yeah, and unfortunately, more often than not, we see this, and I hope it doesn't happen to you guys out there, but people come to us once something's caused them financial pain or hardship. They're thinking, oh my gosh, this tax bill. Or, oh my gosh, I'm paying a lot for my Medicare supplement or my Medicare coverage, or, oh my gosh, my parents left me this mess with our estate plan, or my investments are losing money and my current advisor's not helping me, Matt. All these things happen, and it causes someone to pay attention to it, wake up, oh, that hurts. And we don't want that to happen. But like I said, more often than not, people come to us, and in this situation, this couple was nearing retirement. And as they were nearing retirement, he hadn't quite left the workforce yet. She had, because they'd noticed her kind of declining. And she'd actually been diagnosed with some early onset dementia. So thinking they were doing the right thing, they started making and putting things into motion without consulting or maybe even asking with a professional what would be the best plan. They started to sell the house thinking, oh, it's paid for, but we need to do something with this money. So they sold their house and they said, well, we can live with our son and maybe we can build a small mother-in-law's quarters on the property. And that way we can maybe start planning for that. Good intentions, but bad execution there because there was a lot of things that they really didn't know they should be paying attention to.
Well, it sounds like it could be a logical move. It also sounds like a move that could be troublesome without looking into all the potential scenarios that could come into play. Matt, you often talk about the pebble in the pond analogy, where the pebble splash has a ripple effect across the water. And Joshua, our lead CPA with Market Tax Services, what would be some of the tax implications that could come rippling into play with this move?
Yeah, so at first pass, this is going to sound like a great answer tax-wise, selling off the primary residence. Because in our tax code, so long as you've owned the property and lived in it for at least 2 of the last 5 years, the gains you might see out of that transaction, the proceeds all come back to you free of tax. And that makes this sound like a great way to get some cash, to move into that retirement phase and not have to deal with Uncle Sam on it. But the downside that they're going to experience, and it's not going to be the year they do this, it's not going to be the next year when they file their taxes, it's going to be years down the road, is that whatever they do with these monies, whether they invest it, whether they just put it as savings in the bank, it's going to start generating taxable interest, it's going to generate capital gains if they invest it in the market. Even if they don't do anything with it, it could generate dividends, it can generate interest, and that's going to cause problems both generating its own taxes, plus, since they're going to be retired, it's going to may generate taxes on their Social Security income.
Matt, now I'm gonna go out on a limb here. It sounds like a move like this has a lot more planning involved than meets the eye to do it correctly. And it also sounds like having just a financial advisor involved would leave a lot of stones unturned as to the possible negative outcome that a whole team involved in the process could help alleviate.
Yeah, as a financial advisor, I'm licensed to give investment advice, not tax advice, not Medicare advice, not estate planning advice. And it helps to have those professionals all here because as they're coming to us, every one of these professionals came in that room and added to the conversation helped get answers in the moment, because they had started this process without us, which I wouldn't encourage because they had some missteps here. So now they're coming to us after they've sold the house, they've moved in with the son. He's starting to look at when is the soonest he could retire, and that's why he finally engaged us. It's like, okay, when do I turn on my Social Security? What do I need to take out, and how are the tax implications going to happen with my retirement account on my Social Security with that when we start taking money out of there? But then they had also this notice from their long-term care insurance. He had a policy, she did not. And unfortunately, that was backwards because she was going to be the one that probably was going to be needing the care. But he'd been sent this notice that said he was going to have an increase in premiums or he'd have to reduce his coverage. So I brought in Bill because he had questions. This gentleman that we were meeting with, he had questions and said, well, how much is Medicare going to cover for long-term care for my wife?
And it's not.
Yeah, and that was unfortunate for them to hear that.
Medicare is not designed to pay for long-term care. A lot of people, when they read about Medicare, they read the description of what Medicare covers. There's a provision in there. It talks about skilled nursing facility care. And when people read that, they're mentally thinking nursing home. And that's not what that is. That is actually rehab care. And usually it's following a stay in the hospital.
And so when you help them kind of weigh the decisions of either increasing their premiums or decreasing their coverage, and that's a difficult conversation to have.
Yeah, and so you have to take a look at, long-term care insurance has a lot of variables. And so you have to take a look at all of those. There's a deductible that you can juggle a little bit. There's a monthly amount of coverage you can juggle. There's a length of time or amount of money that's available to pay for care. There's different forms of inflation coverage.
Can be any number of variables.
Yeah, and and I've helped people many times over the years tweak it to get it back into so they still have good coverage, but get it back into an affordable range.
But the unfortunate thing here was, again, they thought they were doing the right thing. The house is paid for, let's move in with the son. That's a big risk, right, Gerald?
Yeah, that's right. I mean, part of the situation here is that they are very likely, should anything happen to the husband, she would be in a memory care home or basically long-term care facility. And when you are in that situation and you usually turn to Medicaid for help to pay for your bills, Medicaid has a lot of rules as to how do you qualify for Medicaid. And one of the things they look at is your assets. Now, in order to review your qualifications, they look to see what assets are exempt and what assets are counted. Counted assets are considered to be available to you to pay for your own care. Exempt assets are not. Now, when you have a couple like this, as long as one spouse remains in the home, that home is not considered a countable asset and therefore exempt and not subject to Medicaid spend down. However, they really didn't have a home per se anymore. They had turned that exempt asset into a potential non-exempt asset. There is some question. Basically, they bought a double-wide trailer. There is some precedent for Medicaid treating that as a home, but sometimes they may not in other cases, depending on the situation. We had an issue with where it was located. It was located in a piece of land that could not be partitioned off to them. So we probably could not be able to exempt that asset, or at least fully exempt it. And now all of a sudden, they were looking at spending down money that they didn't need to.
So all kinds of situations and scenarios that could develop even further. And they came to us and they were glad because they got all their questions answered under one roof. And we started helping them make the best of a worse situation.
As you can see, retirement planning, to plan in your best interest, does require a whole team, from the financial aspects to the tax implications, as well as Medicare advising and estate planning. And at Market Advisory Group, that's exactly what we provide, a holistic approach to retirement planning. If you'd like to request a complimentary no obligation consultation, Our operators are standing by right now to take your calls at 316-252-8707. Again, the number 316-252-8707. Or if you'd like to leave us a question online, you can do so at ionretirement.com. We'll be back right after this.
When people work with Market Advisor Group, they get a feel of sense of family. There's a lot of relationships that are made and going on in this conference room, and we really take a lot of pride in that and a lot of satisfaction in that.
Every client we work with, we make a custom-made plan to fit them and help reach their goals in life. Another thing that makes us unique is we want to meet regularly with our clients and have reviews.
Market Advisory Group, we have a process, and the process we take people through is first to understand what they have, understand who they are, and then we put together an income plan for them and show them how they can look forward to retirement and not look, though retirement is going to be a stressful time. It needs to be a stress-free time.
A few unique features of working with Market Advisor Group is holistic in-house financial consultants. We've got an in-house CPA, Joshua, an in-house estate planning attorney, Gerald, an in-house Medicare advisor, Bill. We rely on all of those professionals for, again, additional service within our consultative process, making sure that we've got the advice and the expertise behind the recommendations that we make.
You know, as an advisor, I'm not there to sell them one way or the other. I'm there to educate them, to let them know what their choices are. Then I try to help them make the right choice where they can save money and feel confident in their decision.
Absolutely, the best part of my job is getting a stack of paperwork from somebody and they don't know what to do, and then I can turn around and give them back a tax return, but also to be able to explain what they can do next year that will give them a better answer than what they had this year.
When we've got clients that are calling and they need to help out a child or need to help out a grandchild or need to help themselves out and they're in a situation they didn't expect to be in, I really relish the opportunity to help them through that, help them make the educated decisions in somewhat stressful situations, because a lot of folks don't have that type of counsel.
We meet with so many people one-on-one in this office that don't ever end up becoming a customer or doing business with us, and that's okay. But when they leave our office, we know that we've helped them either get some answers to some of the questions they had or get some clarity on maybe their own path.
But one of the things that we hear all the time is, I wish I would have met you guys 10 years ago, because how much further could I be down the road? Well, Johnny Appleseed said, you know, when's the best time to plant a tree? 10 years ago. When's the second best time? Today. And so if we can help people today going forward, that just brings an incredible amount of comfort and excitement for us to come to work every day.
Bill Vawter, Senior Medicare Advisor with Market Medicare Advisors. In our last scenario that we illustrated for folks, Medicare had a big role in the planning of that retirement situation. And with the current economic climate that we're experiencing, we're hearing a lot of words used to describe it. Global tensions, rising interest rates, and market volatility come to mind right off the bat. Bill, are there any tricks or tweaks that can be made when it comes to the Medicare piece of retirement expense to help?
Actually, there are quite a few tweaks. You have to take a look at the version of Medicare they've chosen to go with. For instance, if they've stayed with traditional Medicare and a Medicare supplement, those vary greatly. I mean, here there's over 60-some companies that offer the exact same contract, but the premium can vary over $1,500 a year different from high to low. And so it's important to take a look at that list and see see if you're in one of the lower priced companies. Another example would be if you're on the other version of Medicare, there's different companies that have different co-payments, different out-of-pocket limits, and then there's some plans are better than others. And if your plan, it's a good idea to take a look,
Sure.
Match it up to other companies.
Matt, as you've been meeting with clients recently as a financial advisor, are you seeing more people concerned or even aware of factoring inflation into the retirement planning and how to do so?
Inflation is absolutely a concern that a lot of people are having right now, but what inflation is doing to the stock market is probably even a higher concern of most people that I'm meeting with right now. And when we're meeting with people that maybe haven't had a review from their current financial advisor, their financial advisor hasn't even picked up the phone to say, hey, we maybe need to make some tweaks. That's something we're seeing a lot with people saying, hey, I'm down 10, 12%, I'm down 20%. Had a gal that came to me last week in tears. And I feel for her, and we're helping her, but she retired from a hospital in 2019, rolled out about $750,000 out of her 401k. And now that grew over time because the markets had been going up since 2019 to almost $960,000. But last week when she was in, she said, Matt, and she brought in her statement. She said, this statement says $850,000. I've lost almost $110,000. What can we do here? And I said, well, are you working with a current financial advisor? And she said, yes. I said, well, have they called you in for a review? She goes, no. And that was terrible. And so we actually logged onto her account right there, and actually the 850 had gone down to 807. She was in tears. She goes, I'm about to be right back where I started when I left the hospital and started doing traveling nursing. So we started some things, worked on our process to reduce the risk, because her advisor, this is what her advisor had told her last. You're in some risky investments, but we'll make some tweaks when you finally stop working. But the market conditions, inflation, the Fed raising rates, high energy prices, global tensions, these are all things that you should be making adjustments in advance of that retirement date, because as you near retirement, it's critical to preserve as much as the nest egg as possible to make sure it's going to be there to last throughout retirement.
Definitely not the time now for cruise control on a retirement plan.
Absolutely.
Joshua, Social Security taxation, those numbers are something that people have to take into account. And with interest rates at highs not seen in decades, my guess would be a client who is sitting or settling for a box store type investment firm with their client on cruise control, they could be leaving that person ill-advised or wide open for painful tax implications.
Yeah, that you're exactly right. So in terms of taxes, a lot of times when people run into inflation is around their Social Security. You know, every year people who receive Social Security benefits get a cost of living adjustment, which is driven by inflation numbers, right? And so they'll get a larger and larger benefit as time goes on, as that cost of living adjustment just keeps compounding, so to speak. But the numbers that drive how much of your benefit gets taxed are fixed. They haven't changed since 1984. So for a single filer, that starts at $25,000. For a married filer, starts at $32,000. Now tell me, and I think a lot of our viewers would remember 1984, does $25,000 or $32,000 buy the same amount in 1984 as it does today? And no, it does not. So that is like a hidden, sneaky little tax hike that's built into our tax code that nobody talks about, nobody sees, but a lot of people feel the impact of that.
Matt, the importance of working together with a whole team, another prime example of why the box store type advisor strategy may not be in a person's best interest in high market volatility or any other time for that matter.
Well, just another example of why working together as a team is so beneficial, not just from the tax side, but the estate planning side. Had someone come to me the other day, said, you know, we've been retired for a couple of years now, but now we're going to be the caregivers for our father. And he had started to decline, but there were some issues that came into play there because the father thought he had the estate plan all buttoned up. He thought he'd done the planning. He thought he'd looked ahead, been prudent that way. But there was actually some things that really we needed to bring in our estate planning attorney for the client, for their father to say, hey, this might be a little out of date, right?
Well, sometimes banks and companies will try to refuse the power of attorney saying it's been too long since it's been signed. Now, when that happens to anybody, they need to understand that in most states, a power of attorney is permanent. Because what happens if the person becomes senile after the fact? You can't get a newer power of attorney. So powers of attorney are to be respected, except when it comes to the U.S. Treasury Department. They're the only ones who do not accept powers of attorney. But by state law, every state provides that power of attorney is permanent and durable, and it can be continued to use regardless of the time that it's been signed.
There was actually even a trust involved too, but no assets were titled to go to the trust, so that was going to be a useless thing as well. I mean, you hope to clean that up.
That's right. One of the things, people sometimes form a trust, they think everything is done, they have a document, they never been told or they never understood that the trust needs to be funded, meaning assets have to be transferred to the trust for the trust to effectively distribute those assets. And so in this case, they didn't have their home in the trust. So what that would have meant is that they would have wound up having to go to probate court in order to transfer the property into their trust after they died. And there would be no reason to do that since they had a trust.
Do you have a whole team working for your best interest in financial planning and retirement? If not, why would you pay one individual for incomplete advice? At Market Advisory Group, we provide the holistic approach to retirement, from the financial planning to tax implications, along with Medicare advising and estate planning. If you'd like to set up a complimentary, no-obligation consultation, our operators are standing by right now at 316-252-8707. Or go to our website at ionretirement.com and leave us a question there. We may use it online. We'll be back with a listener question, a viewer question, if you will, right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no-obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Hi, and welcome back into Ion Retirement. Bill Vawter, our senior Medicare advisor with Market Medicare Advisors. We have a viewer question, as promised, and this comes from Joan N. It says, my husband is planning on working until 70. He's going on 66 right now. And he's keeping his insurance from his employer, and it covers Joan as well. He says we don't have to take Medicare until he retires, but you've talked about being penalized if you don't take Part D right away. Now, Joan says she plans on retiring in 2 years at the latest, at age 67. She says they'll forfeit anything by keeping their current insurance and postponing, or will they forfeit anything by keeping their current insurance and postponing Medicare?
Okay, so the catch here is, and I run into this all the time. I mean, people come in, they're working for a large company, they have good group insurance, but it's in their HR department, they'll say, oh, you're approaching 65, you have to register for Medicare. No, you don't. The key there is that as long as you're covered by group insurance. Now, the group insurance needs to be, there's a term there that you're looking for, considered credible coverage. You might get a letter from your company or from the insurance company that says this insurance satisfies Medicare's requirements as credible coverage. If you get a letter like that, you need to hang on to it. Put it with your insurance documents because you may need it later on as proof of insurance as to why you did not take Medicare when you were first eligible for it. You could also refer to Part D. Part D is the prescription drug coverage in the Medicare system, And the letter might also refer to that. It might say that it satisfies Medicare's requirements as credible coverage for prescription drug coverage. As long as your insurance satisfies that requirement, you're all right. You don't have to register for Medicare. And some people do go ahead and register for Medicare Part A. There's no cost associated to you for Part A. And so sometimes people will do that to be in the system, but to get any benefit out of Part A along with your group insurance is kind of rare, but we're not going to get into that today. But does that kind of help to answer that question?
It does. And in an example like my own grandfather, he continued working up close to 80 years of age. So as long as a person is covered by an employer's insurance, they can postpone the enrollment in Medicare?
They can. Now, I don't always encourage it. I always say when the time comes when you're eligible for Medicare, then weigh it out. Take a look at the cost and the benefits of the group insurance against the cost and the benefits of Medicare. Some people, yeah, they've got a strong enough group plan. Maybe the employer covers all of the cost, and so the group would be good to hang on to. But there's a lot of people who are actually better off to let go of the group and take Medicare. They'll get better benefits at a lower cost.
I had a client the other day that he walked through that scenario because it was with the district plan. For the spouse that turned 65, it was better to go on Medicare, and the younger spouse that was still working for the school district, they stayed on their health plan and continued on. But they actually
because the employer covered most of the cost for the employee, just not the spouse.
Well, I'd like to thank the panel for this edition of Eye on Retirement. Matt Goolsby, along with Joshua Cicora, Bill Vawter, and Gerald Eidelman. If you'd like to set up a complimentary, no-obligation consultation with our team is looking forward to seeing you and assisting with that consultation. Again, it's at no charge, and our operators are standing by right now to take your calls at 316-252-8707. Again, that's 316-252-8707. You can go also to our website, eyeonretirement.com, to not only view past episodes, but if you'd like to leave us a question, we may use it in a future episode. And if you'd leave your question with a physical address, we'd be glad to send you one of our complimentary Eye on Retirement coffee mugs. That's all the time we have for this week. I'm Rick Everett, here to remind you that we're here to keep an eye on retirement.
This broadcast is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or is excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. Legal services are offered by Eidelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor.